This is the reason Wall Street's most famous bubble spotter says the AI bubble is 4 times bigger than the 2008 financial crisis. Julien Garran at MacroStrategy Partnership ran the numbers in late 2025. He found the AI bubble is 17 times larger than the dot-com bust and 4 times the size of the housing bubble that nearly wrecked the global economy. Nvidia, OpenAI, and the entire GPU ecosystem have created a debt structure that mirrors 2008 in terrifying detail. But when you actually dig into where the money's going and how little is coming back, the parallels to 2008 get real hard to wave away. Let's start with the number that should bother everybody. In 2025, roughly $630 billion poured into AI. Big tech spent about $427 billion on infrastructure, and venture capital added another $202 billion, almost triple what it was 2 years before. AI gobbled up half of all global venture funding last year. Now set that against the actual revenue. Total identifiable money AI brought in was somewhere around $50 to $70 billion for every dollar AI earned. Between $9 and $12 were spent to get it there. Sequoia Capital's David Kahn spotted a $500 to $600 billion annual gap between AI infrastructure spending and actual AI revenue. JPMorgan said the industry needs $650 billion a year just to deliver a 10% return. Fortune pointed out that the 5 biggest tech companies invested about $560 billion in AI infrastructure over 2 years and pulled in just $35 billion in combined revenue. And then there's OpenAI. It was worth $29 billion in January 2023, then $157 billion by October 2024. By March 2025, it hit $300 billion, and by late summer, it reached $500 billion. That came while OpenAI was projecting losses of $44 billion through 2028. Its actual 2024 revenue was about $3.6 billion, and it lost $5 billion that same year. In just the first half of 2025, OpenAI spent $2.25 for every dollar it brought in. Meanwhile, Anthropic and Claude are burning through similar capital with their own AI models, creating a competitive furnace across the entire generative AI landscape. Okay, so here's where people get the 2008 comparison wrong. Most analysts default to the dot-com bust of 2000. And yes, the S&P 500's top 7 stocks make up 34% of the index, almost identical to dot-com peak concentration. The Buffett indicator is at 200% of GDP, which is actually higher than dot-com. But the dot-com comparison understates the risk. It misses what makes 2008 the scarier parallel: debt. In 2008, the crisis was not about housing prices. It was about debt piled on top of debt. Banks ran at 30 to 1 leverage ratios. Lehman Brothers had $639 billion in assets against $619 billion in debt when it filed the largest bankruptcy in American history. The Federal Reserve and Jerome Powell's predecessors had to step in when the subprime mortgage market was $1.3 trillion. But credit default swaps stacked on top ballooned to between $33 trillion and $47 trillion. The S&P 500 dropped 56.8%, and American households lost $11 trillion in wealth. 8.7 million people lost their jobs. 465 banks went under. The government pushed $443.5 billion out through TARP, and AIG alone needed $182 billion. The common take is that the AI bubble cannot be that big because it is an equity thing, not a debt thing. Nvidia's revenue went from $27 billion in fiscal 2023 to $130.5 billion in fiscal 2025. Jensen Huang, built Nvidia into the backbone of AI infrastructure, but that success depends entirely on GPU demand staying infinite. Its price-to-earnings ratio actually came down because earnings grew faster than the stock. That does not scream Lehman Brothers. Yet. But the debt is building fast. AI-tied debt has hit $1.2 trillion. JPMorgan calls it the single largest segment of the investment-grade bond market. Big Tech issued $121 billion in new debt in 2025 alone, 4 times their average over the prior 5 years. Oracle is targeting $45 to $50 billion in total AI debt, with yields creeping toward junk. And Amazon's free cash flow is expected to go negative in 2026 as it ramps to $200 billion in capital spending. Across Big Tech, capital expenditure is eating 94% of operating cash flows, up from a historical average of about 40%. The entire GPU supply chain from TSMC and Taiwan Semiconductor to Nvidia is stretched thin, creating semiconductor bottlenecks that could trigger cascade failures if demand suddenly drops. Oliver Wyman drew a direct line to 2008 in a January 2026 report. In 2008, banks discovered they held far more housing risk than their reports showed, and the same could happen with data center risk. Meta is using special purpose vehicles to keep AI debt off its balance sheet, the same structure that hid risk before the 2008 crisis. Blue Owl Capital and Blackstone merged private credit funds tied to Meta data centers, then blocked investor redemptions, handing investors automatic 20% losses. BNP Paribas froze 3 mortgage funds in 2007, one of the first dominoes of the entire 2008 crisis. Sound familiar? The circular financing might be the scariest part. Nvidia invests in OpenAI, which turns around and buys GPU units from Nvidia. Nvidia also backs CoreWeave, which serves Microsoft, and Microsoft happens to be OpenAI's largest shareholder and biggest customer. The money just circles. Yale's Jeffrey Sonnenfeld warned, this could trigger a chain reaction similar to the crisis of 2008. AI startups are borrowing billions against GPU inventory, lending that analysts have compared directly to subprime era practices. Credit default swaps are already being written against AI debt, creating the same stacking of derivatives that nearly broke the global economy in 2008. Even the people building this see the fraud. Sam Altman said in August 2025 that investors are overexcited about AI and someone is going to lose a phenomenal amount of money. Jeremy Grantham, who called both the dot-com and housing bubbles, wrote in January 2026 that the market could drop 50% and still be within historical norms. We already got a taste. On January 27, 2025, DeepSeek released an open source model that matched ChatGPT at a training cost under $6 million. Nvidia lost $589 billion in a single session. It was the biggest one-day loss ever for any company. Then came the SaaSpocalypse in February 2026, when $285 billion vanished from software stocks. Atlassian fell 35% and Oracle dropped 45% from its September peak. Meanwhile, 42% of companies had abandoned most AI projects in 2025, up from 17% the year before. AMD and Intel saw their AI chip efforts stall as the market questioned whether demand could sustain the massive capital requirements. Not everybody sees disaster. Larry Fink at BlackRock does not think it is a bubble, and Howard Marks at Oaktree says he cannot detect the psychological excess that marks a real one. Goldman Sachs studied 51 periods of tech innovation over 175 years. 75% ended in bubbles, but they say today's AI gains are driven by actual earnings, not just hype. And the bull case is not nothing. Nvidia's data center revenue hit $51.2 billion in a single quarter, and the forward price to earnings on big tech cites around 26, versus roughly 70 at the dot-com peak. These companies make real money. But being profitable and being in a bubble are not opposites. A crash at current valuations would wipe out roughly $33 trillion, more than United States gross domestic product. Citigroup says nearly half the S&P 500 has significant AI exposure. And because Americans hold about 60% of their market exposure through 401ks and IRAs, an AI stock crash would hit retirement accounts harder than the dot-com crash hit most households. The Federal Reserve would face the same impossible choice they faced in 2008. Let the bubble burst and crater the economy, or flood the system with liquidity and risk an even bigger bubble. The 2008 crisis cost Americans $12.8 trillion. The AI bubble has packed even more money into fewer names with less room for error. Whether this bursts like 2000 or cascades like 2008 comes down to how much of that $1.2 trillion in AI debt goes bad if the growth story disappoints. Nvidia reports earnings February 25th. Jensen Huang's guidance on GPU demand could either validate the AI boom or trigger the cascade. That might tell us more about where this AI bubble is headed than anything else in 2026. Someone is going to pay the bill for this debt buildup on the scale of 2008. The only thing we do not know is who.